Good afternoon, everybody. Welcome back to the Schwab YouTube coaching channel known as Trader Talks. Our next topic is after the close, and I am your host, Kevin Horner. Thanks for being here, everybody. We are pleased today to be joined by my friend and fellow Schwab coach, Rachel Deshelle. They're in the chat. Today, we're going to get to a few examples of both bullish and bearish opportunities for consideration. But of course, as always, examples that we're going to utilize to illustrate a process here that some traders might choose to employ. So if you're not already doing so, please follow Rachel and me on X. I'm available there at Kevin Horner CS, and Rachel you'll find at Rachel-CS. Best way to engage with the coaches that you follow here outside of the classes we offer you daily is on X. Please meet us there if you don't mind. I've been posting a bunch this week, bunch of good-looking charts and interesting charts today. Posted a chart on Broadcom, and we're going to look at Broadcom as one of our example opportunities today as well. So lots to get to with all of you. If you're not already doing so, please make sure you're subscribed to the Trader Talks channel here on YouTube as well. Let's get to our disclosures, and then we're going to look at how the market closed today, and we'll set the table for tomorrow. First of all, please remember that our discussion here is exclusively informational and educational. We do not make recommendations nor endorsements for any specific approach to trading the market. We will discuss technical analysis. In doing so, we remind you it's just one piece of your decision-making puzzle. We do want to discourage you from making your decisions exclusively off what you see from technical analysis. So think of it as just that, one piece of your overall decision-making puzzle, not the entirety of it. Today, we will also be incorporating options. It's important to remember that options do carry a higher level of risk. They are not appropriate for all traders or investors. You'll want to make sure that you're familiar with the characteristics and risks of standardized options. That, of course, is a disclosure brochure, and we can provide that for you at any point. You can give us a call for a current copy if you'd like to learn more about that. But make sure that if you're ready to trade options, you have gone through your prerequisite work, everybody. You do need to be approved on each account where you might like to trade options. All right, so with that, let's get to it. Let's take a peek at how the market finished. We do have a new all-time high close in the S&P 500. We broke out of our range there on last Friday, pushed to new high yesterday with a gap move. Today, a little bit of a breather here. We finished up on the day, but not as up as we were throughout the morning. We did hit above 6,900. In fact, our high trade today is 6,911. So we do have new intraday high, new all-time high close as well. Now, the big thing on deck, of course, tomorrow we are going to be hearing from the Fed. We'll be learning to what extent they're going to make any changes to policy. The expectation, according to how traders are positioned, is for that 25 basis point cut to hit tomorrow. That remains to be seen, regardless of the percentage being very high at, say, 97, 98% likelihood. I have to remind you, that's just what traders are expecting, how traders are positioned. It doesn't mean that we're going to get that cut. So a change to that could shock the system a little bit. If the cut doesn't come through tomorrow, the market probably isn't going to like that all that much, to be honest, and could very well use that as a catalyst to take some profits and maybe bring us back into the prior trading area that we'd been. But I don't want to tell you that that's what's going to happen. I'm telling you that it could. And, you know, if you attend many of my classes, you hear me say it all the time. It's important that we evaluate what might happen and maybe some of the less likely scenarios that could play out, but also still be prepared for those less likely scenarios, because it's those situations that often surprise us and lead us to acting in a way we might not be comfortable acting. So if you're always cognizant of potential risks and potential benefits, potential opportunities, we have to know what could go well, what could go wrong. That way we're prepared to act. And again, I'm not trying, Jay, to scare you out of things. I am trying to be disciplined in our process. That's really the key, as you all know. Disciplined and consistency to our trade process will reward us over the long haul. That's what we're looking for. So great move in the S&P. New highs are not bearish. Let's keep it rolling. We'll look at the NASDAQ 100 making a similar move, moving out of that range, pushing exceptionally higher today. This is great. Going through my green line on Friday of last week, you got 3 days in a row with big, beautiful green candles and on back-to-back gaps or back-to-back-to-back gap moves in the NASDAQ 100. That looks strong. Yes, we are making a lower high here in the RSI versus the S&P as well. Both of them making a lower high, but remember, those divergences like this are often just a signal of a pause, not a signal of a reversal. So here, while we might not yet be as high in the RSI as we would like to be, many would like to get you above the last high we made there, which was right around 71.5 or so. And if you can make a new higher high in the RSI, that would be validating in nature from the RSI on this chart of the NDX. That remains to be seen, but again, don't allow a bearish divergence to imply, or rather, we as traders should not infer that a bearish divergence is a signal of a reversal. Okay, so good look here. And then lastly, our small caps also got a little breather today, down about 0.5%. Looks like that's all we're getting out of this is just a breather here. Again, bearish divergence. Okay, so we're going to eye it, but we're not going to lose sight of the true trend, which is moving to new highs, essentially. We do need to maintain our oval here because that is the level of new highs on the Russell 2000. This basically lets us know that we are still above former all-time high levels at what is the white line. And if you looked at that on the weekly chart, you'll see why it's so important for us to hold and maintain. We don't want to get thrown right back into the range we'd come out of here, which was really lengthy, about a 4.5, 5-year range. So staying outside of the top side of that range would be very nice from the small caps side of things. So with that, there is your brief look at how the broad indices finished the day. Does seem to be a bit more red on the screen here today in advance of tomorrow's policy decision. Like I said, could very well just be a little bit of profit taking and a little bit of pause. The VIX climbing in advance of that is by no means a surprise. Probably witness the VIX up a little bit tomorrow morning as well. The policy decision comes at 2:30 p.m. Eastern. Or excuse me, 2 p.m. Eastern, followed by the discussion from Fed Chair Powell, which will be at 2:30 p.m. Eastern. So that 30-minute window, need to be aware of that. Good chance we'll see the VIX a little elevated in the morning as traders position in advance of the announcement to be maybe hedging their longs a little bit. We'll see to what extent that plays out. But as you can see, that big spike we had on the VIX here back when the president made his comments on trade with China, we have quickly gotten thrown back to more, more of the basic area we've resided in the VIX for much of the last few months. Okay, so with that, let's take a couple of example looks at some positions here and really some ideas of how we might go about things. As you remember, we built a watch list for after the close, and it's littered with stocks that have been in uptrends. But there are going to be some opportunities in here that we want to look through. So we can always, as a reminder of process, one of the things that many traders will do is just continue to build their watch list of opportunities. Sometimes they'll define it as entirely bullish. Some will define it as entirely bearish. Some will define them by time frames. It's always important to be considerate of the window of time in which you would like to place a trade. But whatever the case, apply that watch list to your left side of the chart and then go through your chart triage. And today I've sorted this based on the downside move. So basically putting the weakest of the list at the top. And I'm just going to click on it here and we'll work our way down. So as we do this, one thing I'm noting here on this D-Wave Quantum, quantum stocks have been volatile. You had a huge move to the upside. We unwound that a little bit. The concern here, I'm going to zoom in a little bit. Notice the action around the 20-day moving average. The 20, we were above that 20-day in orange for a long while. And then we had this pullback that put us below it 1 day, 2 day, 3, and 4. Then day 5, hey, we're back above it, nothing to see, right back on pattern, right? No concerns, except if this day, if to yesterday's price action is actually the high in that bounce, well, then today gives us a close below the low of the high day. That could signal some struggle going forward. Maybe it means another test of that last level, which would be down in the vicinity of the last low, and happens to coincide with that 50-day moving average. And again, we don't know what's coming, but when you see a maneuver like this, where we were back above the 20-day for one whole session and nothing more, and then the very next day we were below the low of that day, hey, that stands out. Some traders might look at this as a potential bearish situation playing out, might very well look at it as a bear flag, Rice Bird. Absolutely. I could certainly draw that in. You know, we go from the peak to our bottom, up like so, nice and steep. Look how steep that channel is. And this action today would validate that view. Now, if that were the case, hey, just take a little measured move target. Some traders will add it to basically the peak of the bounce. That'll give you a more reasonable estimation for a measured move target. But again, remember, measured move, no guarantee to be achieved. Another trader might say, I'd prefer that line be drawn from the bottom of the bull flag, and they might draw it like that. But that should give you an estimation. Remember, I think a lot of traders will default to doing things a bit more conservatively when setting their targets. I think that makes a lot of sense. That way you're not finding yourself trying to make it to your max level all the time, right? By taking the measured move calculation from a slightly higher level, well, now you're suggesting, okay, I can start covering as soon as I get maybe into the vicinity of $17, $8.50, $18, somewhere in there. You wouldn't necessarily have to fall to the 200-day moving average. But boy, when you look at that, it all kind of coincides, doesn't it? So I think that's kind of notable. We'll see what happens on that. I don't have a trade on D-Wave today, but I wanted to keep moving. Let's see here. Here's MicroStrategy, or formerly MicroStrategy, now Strategy. Still in a bit of a, as our friend Barb Armstrong would say, a bit on the struggle bus. You had a rejection at the confluence, or the death cross here, with the 50-day crossing the 200 to the downside. Again, these bounces are intriguing for the bullish trader. I know you look at a new low and a bounce back into it, and the trader starts thinking, oh, this is great. We're going to be right back on path. I know it's going higher from here, but you know what? It didn't. And in this case, it rallied in and made matching highs. Matching, not higher highs. One high, another, and then the third was this instance right here. It tried and couldn't do it. So Strategy looking kind of bearish as well. In fact, some traders might take that line and extend that all the way out to where we are right now, just to give you something to eyeball on any potential rally. I mean, a rally back up to there is going to take some work, mainly because, not just because we're in a series of lower highs and lower lows, but we're below all three of the major moving averages here, no matter how you look at it. 20-day, 50-day, 200-day. You have to get through all three of those to find 360 again. So not exactly a fantastic chart on Strategy. All right, moving on down the line. Next is Toast. And you know what? Toast actually looks interesting from a bearish standpoint as well. They have earnings coming up. Earnings on deck next Friday, the 4th. And this one I am prepared to talk about a little bit, because I was thinking as a bearish scenario, when you notice once more the confluence of the 20 and 50-day, the bearish cross, the death cross in it stands out. The last time we had price action into that 50-day moving average back there, it was rejected, made a lower low in the short term, rallied into the 20, and then made a lower low thereafter. Now, it is possible, entirely possible, that this won't play out bearishly. We could be looking at a validation of the 20-day moving average acting as new short-term support. right now I could draw a line right through, right in this vicinity here. You can see all the action at this $37 approximate level, right? So let me put that in here, 37. So that's a notable area. But if the trader were feeling bearish and not terribly expectant of any positivity associated with that November 4 earnings coming out, then perhaps the trader is thinking, yeah, there might be an opportunity to put something on. Now, one thing we know about trades in advance of earnings is that we expect IV or implied volatility to be a bit higher. This is where it can be helpful to consider spread scenarios. So yes, it might be more costly to own a put given the downtrend here in the stock, given the upcoming earnings window next Friday. But I thought we could look at both. A long put vertical as an example of how maybe a more aggressive trader might consider it. They might want to spend that premium for an opportunity for profit to the downside. And then we'll also do a short call vertical, which will be limiting our risk. Okay, so we'll use the spread to set a risk-defined approach on the selling of premium in advance of earnings as well. And that way, when we reconvene next Tuesday, we'll see how both of these played out. One will have a greater opportunity for profit, but requires the trader to spend money from the portfolio. Of course, the alternative to that is to sell premium, bringing money into your portfolio. And again, they're both considered to be bearish transactions, but one will profit a little bit more than the other. So you can see how the two will play out. So let's look at Toast for next Friday. So we're going to go to our trade page, go to the November 7 period here. And I'll remind you, November 4 is the earnings. So there is always the opportunity, everybody, that you decide to close this out early. Now, the level that matters beneath us is that 37. The level above us that seems to matter is that 39.40 zone, right? So 40 is pretty close to the 200-day moving average. It's 39.31, and the 50-day is 39.5. So from a long put side of things, I think many traders are going to look probably at the ballpark of $40 to be the owner of a long put. I think what we're going to find is that the long put at 40 is going to reflect maybe not as much activity as we'd like, but it is going to reflect an opportunity for this stock to be a higher likelihood of this stock being under 40 at expiration. In fact, we notice the delta here, 64 cents. So quick reminder, the delta is the percentage of likelihood that this contract is in the money at expiration. So about 64% likelihood of that. It's also the equivalent of $1 move in the underlying stock as it relates to this contract. So the $40 contract here bid at $3.50, asking $3.85. If the stock were to drop $1, we might expect to see that increase by 64 cents approximately. Okay, so there's your thought process. That's why maybe some traders would say I'd be more comfortable spending more because I want a higher delta. I want more of the negative move if there is one. Okay, so be thoughtful about those considerations. But from our standpoint, we'll go ahead and look at building a spread using the $40 strike for the long put. And then the short put, let's just go back to the chart real briefly. We've got 37 as our short-term level. And then down below, we do have 35. All right, so could we conceivably build a spread utilizing the 35 ledge? So we build a $5 spread. And if they are in fact bearish and it takes us down through 35, well, then we have an opportunity to max profit. But that assumes that the stock closes under 35 on expiration Friday. So let's take a look at the math there. I'm going to hit continue my trade by hitting the control button and clicking the bid on the $35 put for not 69 cents, but I'm going to be getting somewhere in between 69 and $1.63, probably selling it for about $1 to $1.10. But the net here, the midpoint shows is 252, but I probably do need to spend a little bit more to put that contract on. So a reminder, we're after market close here. So in this instance, we're going to be putting on the trade only if we can do so at our limit price or better. Okay. And so this would be active at market open tomorrow morning. So the purchase of a contract at the current ask of 385, our midpoint, let's call it 375, would give us a purchase on the $40 contract. And we should get at least $1 based on the bid versus the ask on the 35. So let's say that we go in at 275 and see if we can get executed. So now the math on that, I'll remind you, is that when we start building the $5 spread, remember, the most we can make is the difference between the two strike prices, minus what we spend. So if we spend 275, our maximum gain will be 225, and our maximum loss would be the amount that we spend. Not much, nothing more than that. Okay, assuming we don't hold the contracts. So we do have to make that caveat. In fact, I have an example portfolio trade from a few weeks back when I was last with you all, and we're going to look at that a little later, and it's going to reflect a situation where we didn't take action, and what happened afterwards was an automatic execution of our long put. So let's go ahead and submit this one for tomorrow's business. Again, we are spending this money for a long put vertical spread, hoping and trading with the belief that there's more bearishness on deck leading into earnings. Now, by the way, if this one happens to make its way to max gain, let's say that it starts a breakdown tomorrow, maybe it gets to 35 tomorrow or gets down to 35 over the course of the next 3-4 sessions. Hey, it's always okay to consider closing this out, because as a reminder, when you have the spread, you have a defined risk and profit situation. If you make it to the majority of your profit, there is nothing wrong with taking that trade off. For a lot of traders, once they make it to, say, 50 or 60% of max gain, they will cover the risk associated with sticking with it. They're not willing to risk those profits due to the time detail associated with options. So they might choose to close that out even before the company announces earnings. So just keep that in mind. All right, so there's option one as it relates to a bearish trade on Toast. The alternative option would be to consider utilizing that same $40 level and perhaps writing calls against the stock. So selling a short call at the $40 strike, and then setting up a worst case scenario to buy it back or to set you into a risk defined situation so we don't have a whole lot of opportunity for a negative trade. So here in the same viewpoint, now we're going to have a lesser delta on these. Okay, so remember, when we are selling contracts, we are bringing premium in, but our profit opportunity is going to greatly be decreased. So remember, 225 versus 225 gain versus 275 loss on the first trade. Here, if we sold the the $40 call and then locked ourselves into no more than a $1 contract or $1 loss on the per trade basis, we could, I have to make that back, I backed that out improperly. Excuse me, everybody. Give me just a sec. I wanted to go not to the, okay, we're going to do this one more time. We're going to start from scratch. Oop, there we go. I'm going to sell the 40 and then protect ourselves by buying the 41. Now, are we looking at making a whole lot of money here? No, we are not. But we are also, so this would be a maximum of, say, what if we could ask for 35 cents? Great. Maximum, we could make $35 on a per contract basis. That's not a lot, right? I recognize that. You recognize that. But it is a different strategy than spending that money. You're bringing money in. Now, what's your worst case scenario here? The worst you could do is to lose the difference. So it's only a $1 spread, right? So we would make 35 or lose 65. Okay. Now that might not be the proper thing for some of you traders. Maybe you look at it and say, Kevin, I would never risk $35 of profit to lose $65 on the trade. And you might be comfortable ignoring this concept. But I remind you, the 30 delta on the 40 contract, or the 38 delta, tells us that we have just a little better than a 1 out of 3 chance that the 40 contract is in the money come next Friday's expiration. So while the long side with a delta at 65 cents has a higher probability of being in the money, this has a much lower probability of being in the money. Okay. So I think your question's entirely valid, Rocco. 400 contracts of open interest, certainly big enough for somebody playing 1 or 2 contracts. Same can be said here on the put side at the 40s. Open interest was only 85 and it only traded 8 today. You're not exactly a small fish amongst a massive pond like many traders would look for, but it is likely sufficient for a 1, 2, even 5 contract trade given the size of the open interest. But I would be happy to see what Miss Rachel has to say to that extent as well, Rocco. I think many of these details, it can be helpful to set levels that'll make it easier for you, where you could just say, yes, I will consider this one because it's got at least 100 contracts of open interest, or no, I won't because it doesn't have at least 100, whatever that number is for you. 100 just being a generic example. Now, our alternative here, real quick, everybody, is to say, in second thought, I'd be willing to risk more than the $1, and maybe the trader wants to go to the 42 strike, okay? And in doing it that way, suddenly we might be able to get maybe 55 cents to do it, but now we're risking $1.45, okay? So yes, you can bring in more, but you'd be risking more on the back end if we're wrong. Okay, so let's keep it a $2 spread. Let's do it at a mid of, let's get that extra nickel. Let's try and get in there at a limit of 60 cents, and we'll see if we can get executed in any time tomorrow on that one. But as long as the stock remains under 40, this contract ends up being profitable for us. Remember, it's always okay to close early. So in this case, we'll be bringing in $60, and our maximum loss could be, assuming we take no action with the contract, max loss of about $140. Okay, so we'll sell one vertical call spread above the most recent resistance at about 40. All right, there's trade number 2. Now, we don't often get to bearish opportunities, so I wanted to lead with bearish opportunities today. The market's been a little bit volatile, but I have one for you here with a bullish scenario. Let's look at Broadcom. Now, Broadcom has been in a delightful uptrend here. I'm going to highlight just the 50-day moving average. We recaptured it on April 25th, and we have only tested it a couple of times here right afterwards, here, and of course right here, I guess. Nice little hammer candle. And then on the big tariff day with the president talking about China, we found the 50-day and moved off of it. And then now today, dabbling, we closed at a new all-time high in AVGO. So quickly, if we thought as traders that we have more upside from here, well, then we should be considering a call spread and the opportunity for a potential move of trend hereafter. Some traders would tell you they start looking for the short-term moving average to start providing support. It's been largely above the 20-day, and the instances where we've been beneath it have been short-lived and have found support at the 50. But They do not have earnings coming immediately. So this is one of those situations where maybe the trader's a little less inclined to cap their upside by selling a call above the long call. So maybe the trader's thinking, I like the upside situation. We've had a move through, we're going to call it, I'm just going to use some round figures here. So let's talk about 370 being our peak. And then last bottoms here, we're right around 325. So let's just put that down here at 325. All right, so that means we've got about a $45 movement. Whoops, let me make sure I put that in properly. About a $45 range that we are attempting to break from. Now, we don't know if that's going to happen. But if we did break it, some traders are going to start targeting about a $40 to $50 move to the upside. Now, again, from a trader standpoint, we've got to be disciplined. We don't want to think about making 50 points necessarily, but if we're going to give it about 10 days of time and 8 to 9 sessions of price action, well, maybe we could look to make about 20 points. And I think a $20 spread would be a reasonable scenario to consider. If it were in fact to break out. Now, again, this is after the close class, so we are positing the opportunity. We don't know. We do have the highest close, but we don't know how it's going to look tomorrow, right? So we are admitting there's some risk here. We know that. So perhaps building the spread makes the most sense. And in doing so, we want to remind ourselves once more about the thing that matters to us as a trader most. Are you the trader who is willing to spend less for a less likelihood trade, a lower delta, right? Do you want to buy a contract higher than the close today, okay, which is going to be a low delta relative to one that's in the money? And if we looked at, say, where the most recent move began, maybe it's this back at about 350, right? Right in there, that little gap ledge from last Thursday into Friday morning. Now, 20 points in the money is going to be expensive, but don't worry. If we're considering 20 points in the money and we want to give this stock an opportunity to push a little bit, we're going to cap our upside, and that cap is going to reduce our cost. So let's look at those calls, and let's talk about next Friday's calls, again, November 7. And we'll start evaluating based on some delta situation here. So let's close down a number of these because we're going to be pretty much right at the money approximately. So here we are at 373 at the close today. Now the 370 call, just slightly in the money, has a delta of 55. So about, 50-50 shot of being in the money. Okay. Seems like a lot to spend for a 50-50 shot of being in the money at expiration. But one thing you'll notice is the open interest and volume here is a bit more substantial in Broadcom. So Broadcom is at least active in this way. And Rachel agreed with my assessment. Be a small fish in a big pond. And if you are less than 10% of the open interest, you're likely okay. Good point there, Rachel. I like that you assigned an actual percentage detail there. You can always, again, set your levels, everybody. We're not giving you specifics. We're giving you generics. What we want you to do is to have that plan, define your own confirmation. What's the delta that matters for you? Those types of things are what are important in building these out. So let's consider, got to go a little further, right? We did 55-cent delta, maybe not enough. The 66-cent delta puts us at a 360 entrance, so about 12 to 13 in the money. So yeah, we're going to spend a pretty penny there to buy that 360 call. But if we think that we have the opportunity, well, then maybe we build about a $20 spread, 360 long call, 380 short call. Look at the 380 strike. So here we've got another bit of open interest, another nice chunk of volume today as well. So reminder, what do we know about open interest and volume? The volume you see today is not assigned to open interest as of yet today. Tomorrow's open interest will reflect the number of contracts held overnight. So this number is going, the 360 number, absolutely going to climb. The 370, pardon me, the 380, absolutely going to climb. So open interest is going to be there. All right. So if I press Control and click the bid on the 380, I have built a 360 by 380 long call spread. Looks like the natural here, the mid of the natural on the bid versus the ask of these contracts is right around 1120. And that means that we would be spending 1120 for the opportunity to make the difference between it and the $20 spread. 880 would be our max gain on this situation if we got executed at 1120 and we traded just the contract. So the couple of things. There's a good, it's not quite 50-50 on the 380s, right? But there's a decent shot that we get above 380 between now and next Friday expiration. And there is an opportunity that the trader could be looking at about, say, 700, 750 of profit from a max of 880. They might very well look to take that trade off. Okay, so 360, 380 spread. Some traders would say, I'd like that to be closer, and maybe they'd consider, instead of 360, 380 for 1120, they might say, let's do 370 with 390. And it's going to be less cost, but remember, less cost because the delta on your sell side is lower. It means we have more risk associated with it. We don't have a guarantee in any way of getting to 390 or through it. So our max gain might be higher, but we also have a lesser probability trade, right? Remember, the 370, the long side, it's pretty much just a 50-50 shot of being in the money at expiration. So the more you are looking for comfort, for confidence on your long side, the deeper you might go in the money, okay? Yes, you end up spending a little bit more, but you also have a higher probability transaction, okay? So just wanted to illustrate the differences between just shifting even just 10 points makes quite a bit of difference here. So we're going to go back to the original. We'll go long the 360. We'll look to sell the 380, both of which are for next Friday the 7th. And we'll see if we can't get ourselves into that at around the 1120 debit for a max gain of 880 and a no more than the 1120 loss. We would be happy to move on from if it moves against us. So we'll go ahead and put that one on. And then we will speedily discuss the opposite end of that. Remember, if we are willing to do a long call vertical as a bullish scenario, we can do a short put vertical as a bullish scenario, which then allows us to bring premium into the account instead of spending that premium, right? So maybe we looked at exactly the same thing. And if you're feeling like, hey, this is not going to break through, I'm thinking I should be of the belief that there's a situation. I think it's going to break through, but I don't want to sell. Excuse me. I don't want to spend my money. I want to bring money in, and I still think it's going to break through 370. Well, then maybe you start selling with the 370 call, or the trader wants, again, pardon me, the 370 put. That maybe the trader wants deeper in the money. And again, think about your delta, okay? When thinking about that delta, if you're the seller of the contract, the lower the delta, the better for you, the less probable that contract has of being in the money. So could the trader start at 370 by selling the 370 and perhaps buying the 360? Sure, nothing wrong with that. It's going to be a fairly limited opportunity, but not terrible. I mean, you can put yourself into this one for about a credit of $4. So you could bring in 4 points and lose no more than 6 approximately, right? $10 spread, credit of 4, max loss is the difference between the strikes, less what you brought in. So that's one consideration. The same trader, though, could say, you know what? I'm not convinced it's going to break out, And so I don't like the 370 strike to be the initial short put. So in which case, maybe the trader starts with the 360, okay, an even lower likelihood of being in the money at expiration, and writes a $10 spread at the 350 level. Now, still 10, still bringing in credit. It's only going to be 3 points at approximately, which means, yeah, you're only bringing in $300. You only have a max risk of 700, but also a much lower likelihood of either of these contracts being in the money at expiration. Okay, so let's go ahead and get this one on as an example. Selling the 360, 350, $10 put spread to bring in 3 points, max profit of 300, max loss of 700, assuming we take action and don't put ourselves in the contract. So there you go, everybody. My goal today was to, because I've heard so much from so many of you, every time we consider bullish spreads and bearish spreads, and I do a long call vertical, I always get somebody saying, hey, why not consider selling the put? So I thought, let's do the same positions and same securities, but let's just shake it up a little bit. I'll give you one long contracts and one short contracts on each, one bullish and one bearish. And then we'll see how these play out come next Tuesday when we reconvene. They should, I think we'll have a decent shot at getting these contracts executed. So we'll take a look at those next week. In our final moments, I just wanted to highlight the last time I was with you a few weeks ago, admittedly, back on October 7th, we put ourselves into a trade on McCormick. And McCormick at the time was an open contract situation. We did a long put spread on MKC. I'll show you this here. And what happened was we got the contracts, and the stock has been in this downtrend. Notice it failed again at the 50-day moving average. But because I wasn't here to manage it, our long put resulted in me selling 100 shares I did not own. And so that's where I am right now in the position. I have the McCormick's short 100 shares on loan. I am profitable. And in order for me to close this trade out, I just need to buy them back for a profit. So we're going to do that. We're going to do that in the aftermarket right now because I want to take that risk off the table. So I'm going to simply create a closing order that says buy at a limit. And I hope this is not necessarily new, but if it is, it's good instruction. Change your time frame from day to PM. And now we are going to purchase this at essentially the asking price to take this trade off in the after hours right now. This one's going to execute probably bingo right away. Oh, of course. And of course, because I said that, it won't. So that's what I get for thinking I was going to get that to work for me. Let me go back to my monitor page. Let me just take a look at that order. I thought for sure. Yeah, it says PM. So apparently it's not going to go with my execution, but that's what I was going for, was to close that out. I might have to close that on my own time tomorrow here, but we'll see how that looks. But nonetheless, be on the lookout for the Toast opportunity and potentially the Broadcom opportunity coming tomorrow. We will revisit these with you all next week on the 1 week from today, because our new segment here, our After the Close, is on Tuesday afternoons at 4 Eastern. Then I will, in fact, be back next Tuesday for that. So thanks for being here. Thanks for participating. Big thanks to Rachel, as always, in the chat here. Make sure you're following the two of us, that is, on X at Rachel-CS, at Kevin Horner CS. I will be back with you guys tomorrow morning for Trader Talk in today's market. That is at Market Open, and I'm joined by Brent Morris tomorrow. So hope you all have a fantastic rest of your Tuesday. I look forward to catching up with you again real soon.